This is our Forex blog for September 20th, 2011, and we've released a new version today that has two minor changes. The FX trend reversal has new options for labeling or the size of the dots and circles. Before, it just allowed you to have the dots and circles the same size, and now you can have different sizes for the dots and the much more powerful triangles, I meant to say. If you put 0 for any of those sizes, then that particular one won't show up. So if you don't want to see the 10 and 15 minute one, you can put a 0 in there and it's gone. I've also updated our FX IntelliStop. Instead of using those dots that you'll see on previous days, you can see that I have the trailing stop lines just like the regular chandelier. So most of our counter trend signals are dots, circles, triangles, and by having these now have the normal chandelier stop look, you won't be confused with as many dots on your screen. So that's the two changes in today's software. Trading wise, we want to trade the same way. We want to buy the strongest currencies, especially when the longer term trends line up with it. You can see the real-time strength and weakness on the top. The dollar was showing some counter trend weakness at around 230. The intermediate time frame trends down. The daily trend is still up at that point. Weekly trends up, monthly trends up. So you don't know if a counter trend move is going to last all day, but most of the time it lasts for 30 minutes to 2 hours, and then some strength comes back. Whether that strength stays strong the rest of the day or only an hour here, as you can see, and then another hour of weakness, 3 hours of mostly strength, hour of weakness. When the longer term trends up, there's no way of predicting how long the weakness will be. It can be the beginning of a new downtrend, which always starts on the fastest time frame bars. It goes from the histogram to the intermediate time frame trend. The daily trend then shifts down, the weekly trend shifts down next, and the monthly trend takes the longest to switch. On a perfect day, the easiest trading days, you have time frames of one currency that's weak on all time frames and another one that's strong. On days like this, there's really, other than in New Zealand, which had a daily trend that was down until about 6. All the time frames lined up a little bit after 6. Really, that was the only one that was strong on all time frames. The Swiss got weak around 8:30, and all time frames are showing weakness. So really, one of the higher odds trades, when all the time frames line up after around 8:30 right here, would be to simply buy the strong New Zealand versus the weak Swiss. Let me bring up another chart here real quick, and I'm going to go over this in a regular class. These are the build your own color strips. New Zealand, Swiss, strong New Zealand, weak Swiss. Hold on one second, I put on the wrong layer. So one currency is strong on all time frames, the other one's weak. You can see here it shot up at 8:30, but on a 5-minute chart, it's a lot harder to find an entry period on this. You can go to our range chart by typing in 6R, that's 6 pips per bar. If you want 8 pips per bar, you'd type 8R, hit enter. It downloads the tick data and then intelligently creates these bars. So you can see on a range bar here, the New Zealand Swiss, there's actually many opportunities to get in on pullbacks here. And if you got out during this chop, or you bought again the breakout right here, your stop might have been right underneath this bar right here. As soon as it went up, came down, you don't know if it's going to continue up or not. You move your stop up near break even, a few pips underneath it. If you missed that trade, you have this nice little pullback trade here as well. And you also, most of the time, strong currencies will work their way to the fib target. It's hard to draw fibs on regular charts most of the time, but notice how it just touched that level. It also happened to be the 50 half number as well. So very high odds trade right there. And that's, even if you bought this pullback here, you made 10, 20, 30 pips. If you bought the breakout, you made 10, 20, 30, 40, 50, 60 pips on that one. Currency meter showed it. There was no doubt that the New Zealand was the most consistently strong ones. It never was pegged at 100, but this tool is made up of 3 directional tools, which means the New Zealand's going up against other currencies, and it's also made up of 2 intensity tools, which measure the intensity both bar by bar and also intermediate time frame trend. Now, when this one got weak right here, you could also try to find another currency that's strong. The dollar has a strong weekly, monthly trend, and so does the yen. The yen had, more weakness a little bit before that than the dollar. The dollar, you can see a lot more strength at 830 than the yen had. And so even if you miss the first move, looking to buy the dollar versus the weak Swiss, makes sense. Let's find the range bar I left running overnight so you can see it on a range bar chart as well. Here's the dollar Swiss, and this has our build your own currency meter in it, which only works live. When you add it to the chart, it doesn't do past bars because this is made up of multiple different ones of our statistical tools with different weights, and there's no way to line up the past bars. So this is what it looked like live. And you can see just off the charts statistical strength here. During this pullback, there really wasn't much weakness at all. So if you had bought this little move down here, you might have had a few pips win or a 5 pip loss. You have a nice little beautiful flag pattern on this. And you can see as this thing starts going back up right here, incredible statistical strength. It's very likely to continue to go up. So you don't just get out of this trade with a quick 10 or 12 pips. You kind of hang on. Maybe you would get out half of it here as it kind of goes sideways. And again, most of the time these strong currencies will work their way up to the fib targets. So from this to the 1.618 fib target, which is a little bit off the screen, you want to look to exit your trade. You would have been in this trade somewhere around 88.40. Maybe you got out of half of it at 80. So you made 40 pips on half, and you made 70 pips on the other half. So you netted 55 pips on that trade while risking less than 10. And a lot of these trades, since we're using a certain number of pips per bar, and we have tools in the software that let you know what a logical, intelligent, statistical number of pips per bar, which equals, let's say, a 5-minute bar or a 15-minute bar. 6 pips per bar would be a little bit more than this normally trades on a 5-minute chart. 5 pips per bar would be that. I just made all my charts the same at 6 pips per bar. But nonetheless, by getting into a trade, you can just simply put your stop 1 to 3 bars underneath the previous bar's low or the breakout bar's low, and then you risk a logical number of pips based on that currency's volatility. The less volatility, the smaller your likely profit target is. Most of the time, you're not going to catch 50 to 70 pip moves in the dollar Swiss. It doesn't happen that much. As you can see, this little sideways range here, when it fell 30 to 40 pips. A little pullback, continued down about 20 pips. Unless there's news going on, 15 to 25 pips is a decent number to anticipate. Earlier today, you can see both the dollar and the yen became really weak. The Swiss had decent strength there. The Australian did. You certainly could have bought the New Zealand dollar and the New Zealand yen earlier tonight. Let's take a look at these on a range chart. If I have them up, I might not have those. Yeah, here's the New Zealand yen. And you can see that earlier in the night, around 2, the dollar got weak. And you can see a lot of weakness. One little burst of energy here. It falls. The weakness is gone. You have, your first plus 80 strength for a couple hours. And you might have bought this little pullback right here with your stop underneath there. It goes up again, and notice it pulls back again without that much weakness. The weakness is half of what the previous strength is. You also have a nice little sideways range here. And when you get into trades and you see strength, you stick with it. And when the strength kind of falls off, you get out of these trades with small profits. You can always buy it again if the strength returns. So it's kind of going up to this high here. You might buy this breakout. It did lose some strength here. You don't know if it's going to continue or not, but if you do buy it, you can put your stop right underneath 63, and you have your fib target on the last wave, which is probably around 63.25 to 30. Now, if it starts going up and you see strength come in, you hang with it. If it has a false breakout and comes down, and you see the strength disappearing right before your eyes, you can exit these trades, with a 5-6 pip max loss. And you always want to watch the currency meter at the same time. Well, let's see how that one actually continued. So you can see strength just wasn't there. Sometimes the market at the highs, chops around a little bit before it breaks out. Notice the difference between this one. The strength came back and then it kind of subsided a little bit here, then you get a pullback. I personally prefer to buy pullbacks versus, breakouts of the high. If you had bought and waited for this pullback right here, you had the chance to make 20 pips on that trade. Whereas if you buy the breakout, you're risking 10 pips. A lot of breakouts fail. It's a relatively low odds trade. If you've come to our class over the last 5 years, you'll realize I pretty much tell you don't buy the highs or don't sell the lows, unless it's one of the strongest or weakest of all the currencies. And the New Zealand yen wasn't incredibly intensely strong like you occasionally get trends. All right, so we have a weak Swiss. Remember, the yen had, declining amount of weakness here. The weekly and monthly trend is stronger than the dollar. And around 9:30, you start having some strength here. It certainly wouldn't be a bad trade to pull up the Swiss yen chart and look to sell it. I don't know what the right number of pips per bar is. I'm just going to bring it up on a 5-minute chart here. And so after 8:30, when the news came out, you got a little bit of a pullback. You'd be looking to sell it. You can see it fell 60 pips. You get another pullback, fell another 30 pips. If you shorted this pullback on a range chart, you had a chance to make 10 to 15 pips. You got another pullback, another chance to make 20 pips. And this is another perfect example of why most of us have switched to using range charts. With a 5-minute chart, there's where do you get into this trade? Maybe right here or underneath the low down here. On a 5 pips per bar chart, only because I don't know the right number of pips per bar in this one, I don't trade the Swiss yen too often, probably a few times a year at the max. By looking at a range chart, you can see patterns that you can't see on a regular chart. So here was the big move down. You could wait for a pullback like this and go short when it breaks down underneath that bar's low. With your stop above the high, you can see it pulls back 10 or 15 pips. The worst case scenario, you're out at break even on that. If you got short here, when it started to go down with your stop right above the high, you can see it never stopped you out. Whether you got out of that with a 5 or 10 pip win or hung on to it, on the down move. You could have also, if you missed those trades, you just started trading right here. You can see it's weak. Tried to go higher, double topped. You go short right here with your stop just a few, 1 to 3 pips above that bar's high. You're not even risking 10 pips. And if this trade really works, it's likely to go to the fib target of this previous move. So if it works, you're probably going to make 30 to 50 pips. You can always move your stop down above, little sideways consolidation bars like that. Or if you really believe in the trade, exit half the trade there and lock in 15 pips and hold the second half. You probably would want to put your stop above here in the second half, a pip or two. And now it's very possible you have a double bottom right here. Usually the end of moves are double tops or double bottoms. So here's the fib target. We're coming up to the whole number. And you might get out right here. So even if you shorted this at 86.50, you made 50 pips on half. You might have got out of the first half here at 36 with only 14 pips. All right, so 50 plus 14, 64, divided by 2, 32 pips you netted while risking less than 10. So that's really the key. Small losses, bigger wins. Doesn't take a rocket scientist, to use these tools and catch the high odds trades. So that's it for today's video blog.